When we talk about things like layoffs, restructuring, buyouts, what type of emotional response do you see out of a lot of come in?
I would say the biggest thing is just being scared.
Yeah.
The uncertainty, just the unknown is probably the biggest thing. And just making sure that you're staying calm is really key, because when you're going through these types of situations, the fear of the unknown is probably the biggest thing that people are focusing on when they need to be focusing on the future of what.
Welcome to the Semmax Way, the definitive podcast for mastering finance, investment, and retirement planning. Prepare to unlock the secrets to financial success as we delve into lucrative investment strategies and provide expert guidance towards a secure retirement.
Welcome back to the Semmax Way podcast. My name is Matt Landon. I am joined by Kyle Leonard. We are both CFPs, and today we're going to talk about something that I think is a challenging topic for some folks, but it doesn't always have to be. This is really around mergers, layoffs, buyouts, and kind of mastering calm through the storm of uncertainty that comes up. So as we dive right in, Kyle, when we talk about things like layoffs, restructuring, buyouts, what type of emotional response do you see out of a lot of clients or prospective clients that come in?
I would say the biggest thing is just being scared.
Yeah.
The uncertainty, just the unknown is probably the biggest thing. And just making sure that you're staying calm is really key, because when you're going through these types of situations, the fear of the unknown is probably the biggest thing that people are focusing on when they need to be focusing on the future of what this looks like and how it can help them.
Yeah, because it doesn't always have to be a negative thing. Like,
it doesn't.
When I hear layoffs or buyout, or especially with a buyout, it's like you go to the negative, but there also is the potential of, wait a minute, you're offering me $150,000 to not keep working. Yeah. This could accelerate my retirement. There could be some excitement there as well.
Yeah. It can accelerate retirement. It can accelerate what the next steps are, whether that be a career move, or if you're in some type of an industry where you can do the same thing, but now you just get a really nice check to go do the exact same thing. It kind of bridges that gap. It can be a really, really good aspect to your life.
Do you find that certain folks, depending on age, want to continue working, or is it more just personalized? Everyone's unique.
Yeah, I think everybody's unique, but you tend to kind of see if you're getting up to close to 60, 65, you get that buyout, it's retirement. That's the first thing on your mind. If you're under 50, under 55, most clients are like, and prospective clients are like, maybe it's time for me to consider taking that check, because this is something that I may not ever get again, and going somewhere else and just continue working.
Well, and we could do an entire podcast just about folks that are in that kind of gap age.
Yeah.
That okay, I'm 54, I'm 57. Can I retire?
Yeah.
Can I not? Can I even access my money? But there are ways to access retirement funds before that magical 59 and a half without paying the penalty.
There absolutely is. Yeah, there absolutely is. Whether you take it as at 55 and you consider yourself retired and you take it from your retirement plan, you absolutely can take that money early. You can always take the money before age 55 if you want to do the rule of 72T.
Yep.
I don't really recommend it. It's not something that I would ever recommend to a client, but it's there if you need it for a certain reason, but it's not something that I would touch.
There's other ways you can do it.
Exactly.
Yeah,
absolutely.
Well, let me ask you this then. When you think about stepping into this, I think it's really important to know the numbers, to understand the numbers. Where would you say people should start? Like, what's the number one thing? Because it might be, here's the payout amount. Yeah. Is that the most important number? Or
the first thing is to talk to someone independent. I know you want to go to your spouse and say, hey, look at these numbers. Like, it's time to call it quits.
So wait, so are you saying we don't have to talk to our spouse about this?
We definitely need to talk to our spouse, but come in as a couple,
right,
and make sure that we're sitting down with a financial planner, whether it's with us or someone local to you. Make sure that you're sitting down with a financial planner and going over, is this the right thing for us at this moment? And if we do take this, what does the future look like?
So the numbers that I think of right off the bat would be things like, what do I need in income? Or what am I trying to do from a charitable giving standpoint? Is there a certain amount that I'm trying to leave from an asset standpoint? Because I think sometimes people get hung up on I need to have a certain number. It's like, I can retire when I hit $1 million.
Yeah.
Or I can retire when I hit 600. Or 2 million.
Yeah.
Why would you say that focusing on that one number is probably not the best way to go about it?
Because that number it may seem important, but it may not be what you actually need. It depends on what you need, what your lifestyle is. If someone comes in and says, hey, Social Security is all that we need, we maybe need a couple $1,000s more a month, then you probably don't need $1 million saved up. It'd be nice to have, but you don't need it. But if you're like, I'm making, $120,000 to $150,000 a year in income, and I want to keep that standard of living, you might need and probably will need more than $1 million to make sure you're keeping that standard of living stable. And so it really just depends on what that standard of living in retirement looks like.
And then I'd say one step beyond that would also even be not just your standard of living, but what are you trying to do from a beneficiary standpoint?
Yep.
Because we have some clients that will say, hey, I want to bounce a check to the undertaker. It's like, I'm fine with whatever I've got's great.
Yeah.
And we can run it down. Other people feel very strongly about leaving a legacy, whether it's to kids, whether it's to charity, whether it's to other family members or something else. But they want to have that preservation, or they might even be thinking about a surviving spouse.
Yeah.
Saying it's like, okay, I've got a pension, but it only pays out for me.
Yeah.
What about that other spouse?
Yeah, exactly. What happens next if I do pass away early and that pension goes away? Do we have enough saved up to where my spouse doesn't have to go back to work at 80 years old?
So let me ask you this. One of the things that I think helps a lot is building in a flexibility fund. What does that mean? If someone's listening to me just say, flexibility fund, what is that?
Yeah. Flexibility fund is a little bit different than emergency fund. So an emergency fund is really going to be geared towards what do you need budget-wise to survive and make ends meet. That's pay all the bills, make sure that if you get laid off, you take the buyout. You have some aspect where you're not working. You can pay every bill and it doesn't have to go into collections or doesn't have to be missed. Flexibility fund is more going to be geared towards, we make sure everything is paid and then we still want to go out to eat. We still want to go do trips and that kind of stuff to where you have the flexibility to say, my basic needs are met. Now I want to go do the other stuff.
So an emergency fund would be more of, I've got enough to cover the mortgage. I've got enough to cover food, groceries, things of that nature.
The basic living expenses.
Basic living expenses.
Yep.
The flexibility fund gets into, we have enough to where I don't have to cancel the gym membership. In my case, I'm a big Hurricanes fan. I do pay the $20 a month so that way I can watch the Carolina Hurricanes.
You don't want to stop paying that.
I don't have to do that.
Yeah, exactly.
That's not a requirement. It's not an emergency thing, but I like watching the Hurricanes play.
Yeah.
And so I'd like to make sure we build in the budget that $20 a month to continue to watch them.
Yeah, exactly. It's not a standard. It's not a basic living expense, but it's something that you want to continue.
Right.
That's the flexibility fund.
So that's the flexibility fund.
Yeah.
It sounds like that can become much more broad.
Yeah.
So how do you help folks narrow that conversation down? Especially if they come in and they say, we don't run up credit cards every month. We're not overspending, but we don't really know what our budget is.
Yeah. So I think the biggest thing is kind of nailing down, what is what is a spouse or a couple's needs and what is their wants when it comes to spending. So their needs are going to be that basic living expenses. What do they need to survive? And then the wants are what do you want to do, whether it's retirement or, in your life, what do you want to do, whether it be travel, whether it be charitable giving, making sure you pass money on to family and friends when you pass away. What's that look like? Those are the wants. As long as we have the basic needs met, we can focus on the wants.
And then once we get through the wants, do we ever get like the extreme wishes?
Yeah, I would say the wishes. That you could say, I guess, passing money on would be a wish. Heavily supporting or starting your own charity would be a wish. Something that is not something that is going to be right there unless you have sustain.
Well, and I've found with all of this, it seems like there's a reoccurring theme that basically says, if I'm hearing you correctly, and I think I am, you tell me what you want to accomplish, I'll help you with that.
Exactly.
Right?
Yeah.
So if I'm sitting here as someone who's getting ready to potentially accept a buyout or is facing potential layoffs, where should my attention really focus? Should I be stressed out about all the details, or should I really focus on the big picture and sitting down with a clarity of what I'm trying to get to?
Yeah. I think the first thing is sitting down with a financial planner, someone like us, just coming into the office, sitting down, complimentary, completely free meeting, sit down with us, understand kind of what you're getting, what you're being offered, and then how that works into your overall plan. And if you don't have a plan, let's develop a plan. Let's create one and see how everything fits together. So if you do decide to take it, everything's good to go.
So let me ask you this, because there's a lot of people that will talk about putting together a financial plan. Not everyone is a CFP.
Correct.
Or a financial planner.
Yeah.
So I think it's important to talk about the distinction of what a fiduciary is versus not.
Yeah.
And then also what makes a CFP a little bit different and why you may want to work with them as opposed to just someone who just throws up a jingle and says, I've passed a series license and I'm a financial advisor.
Yeah.
So for those that don't know, CFP versus no CFP, why does that even matter?
Well, let's start with a no CFP first.
Okay.
So that would be someone who takes one, maybe two FINRA or, securities exams, becomes licensed and can start providing advice or sell stocks
And
or
they're
mutual funds, and they can do really good jobs, but they're focused on basically selling,
Right.
which isn't a bad thing, but that's their niche.
and there are folks that have quite a
Yeah.
depth of knowledge
Yes,
and a depth of knowledge that
Yeah.
just hold those licenses.
absolutely.
But being a CFP means you go a little bit beyond.
Yeah. You go a little bit beyond. You're not looking at just a stock and what is a stock and selling and recommending or anything like that. You're providing advice tailored to whatever the financial plan dictates. You're providing advice on investments, on tax planning, on charitable giving. It's basically completing the whole circle of what a family's financial picture looks like, making sure everything is taken into account. And it's also providing a fiduciary standard where we're putting our clients' interest ahead of our own.
So I think there's a lot of people that have started using the term fiduciary. Not
Yeah.
everyone always understands it.
Yeah.
So for those that don't know, I'm going to give my definition. And
Okay.
You tell me if you agree or you're like,
Yeah.
maybe a little bit different. In layman's terms,
Mhm.
I think you said it well. It's like it's putting your client's interest above your own.
Yep.
But what that really translates into is if you have two stocks, one of them, or two mutual funds rather,
Yep.
one of them has huge commissions, pays a huge fee. The other one has no commissions. There's no fees or very low fees.
Yep.
As a fiduciary, I'm going to look at it and go, personally, if they're all things being equal, they're both moderate, they're invested in the same technology stocks or whatever, this one is going to cost me less. That's what I want to be in. That's what I'm required to put my client in.
Exactly.
Whereas someone who is suitability based says
Mhm.
they're both moderate. You said you want to be moderate. Either one's perfectly fine.
I think that's fair.
I think about that in a nutshell.
Yeah.
It's like it's looking at that through everything though,
Mhm.
the whole time saying, how would I want to be treated or taken?
Yeah. And I kind of go a little bit further with that. So,
I thought you would.
I tell everybody when it comes to being a fiduciary, I make sure I treat everybody the way I would treat my parents, because I want to be able to sit across the table on Thanksgiving and know that if they bring something up about their investments, I'm not sitting here sweating bullets.
Yeah.
So
Yeah.
making sure that they get the same treatment as I would treat all my clients.
And actually, your parents do live with us, so that
They do.
yeah. So that's not a false thing.
It's 100% true. Yeah.
You're like, I can say that honestly. Why shouldn't, kind of going back to the initial part? So it's like, okay, I know I need to work with a CFP or with a financial advisor in general. Thinking about a layoff or a buyout, situations changing, it can be scary. Maybe they offer you a severance package.
Yeah.
Why doesn't that always mean everything's rosy and hunky dory? Like, can that provide a false sense of security? Yes, no, and how should you think about a severance package?
Yeah, I think it depends on kind of what the severance package looks like. Is it a layoff package, or is it one where they're trying to cut costs and you're one that's getting close to retirement, and it's like, hey, maybe we can go ahead and entice you a little bit to kind of retire early. But it really just depends on the situation. I wouldn't say that everything should be looked at in a black and white manner. There's a lot of gray when it comes to severances and especially layoffs.
So if someone's given the choice, you got 40 weeks severance. Yeah. Okay, that's a healthy severance.
That's a healthy severance.
Maybe it's 26 weeks. Whatever.
We saw that with kind of Wells Fargo with a lot of clients, with a lot of potential clients that have gotten some 52 weeks of severance.
Yeah. Sometimes they offer it every other week. Sometimes it's a lump sum. Usually you don't have a say in the matter.
No.
But if I was going to ask you, hand to your heart right now, if you had to pick 52 weeks lump sum, 52 weeks spread out, what would you lean towards and why?
I would probably lean towards 52 weeks spread out.
Why?
Because I like to know that I'm getting something. I'm not getting a lump sum. Even though I'm a CFP and a financial planner, I still like to know that I'm getting something every certain amount of time, whether it's every 2 weeks, every month or something. And we can kind of plan as a family to make sure that by the end of that 12 months, whatever the severance package may be, we have paychecks coming in.
See, I'm inclined to agree with you from the comfort standpoint.
Yeah.
I would also say it really depends on, do you have another job lined up?
Exactly.
Kind of how far into the year are we?
Yeah.
If you've been working for 11 months this year and you're about to get a lump sum of 52 weeks all at once, that can blow you up from a tax bracket standpoint. But if you're double dipping, if you're getting a severance and then all of a sudden you've taken another job, again, that can blow you up from a tax standpoint. So I think there's a lot of factors that come into play. Yeah. One of them, you hit the nail on the head, comes down to comfort and security and how are we planning for things. Yeah. But I would argue, and again, you're welcome to agree or disagree, you have to have taxes be part of the conversation.
100%. Yeah. Because if you work through June or July and you get a severance that you're getting paid through the next 12 months and you get that all at once, that's a that's a big tax bill.
It is.
And you weren't ready for it. And that tax bill is going to be pretty hefty come April of next year.
And it's amazing how when folks do a rollover, how many people have taken funds out of their IRA and they haven't necessarily thought about how is this going to affect my tax bill next year.
Yeah.
And so you take this lump sum, you say at the same time, well, I'm going to feel a lot more comfortable if I don't have a mortgage. Let's just pull that IRA out.
Yeah.
Let's pull the 401k. I'll pay off the mortgage. We'll pay off the cars.
Yeah.
And then we'll put some money in cash. That way we've got it.
Yeah.
That feels to me like you're maybe missing a piece, or you're not thinking about all the parts and pieces.
Yeah.
So why would you encourage someone not to take a large lump sum out of their 401k or their IRA just for security standpoint?
Yeah. I think the biggest reason not to is knowing what the job of that money's for. The job of that money is for retirement and making sure that when you do call it quits with your work career and it's time now to enjoy life, that you have the assets and the money there to be able to do that. And that money's job was for retirement. It wasn't for paying off the mortgage. That's more down the line of saving extra while you're working to pay off the mortgage, not taking retirement assets out. On top of that, the tax bill and the tax burden and the time frame to make all that up is almost impossible. If you take that money out at 50, 55 years old to pay off your mortgage, it's going to be very hard unless you're very diligent on saving a lot of money every single month, every single year to make up that difference. And now you're just breaking even.
So I would say, you're saying basically don't let this short-term stress blow up your long-term plan.
Exactly.
And think about things from a long-term perspective.
Yeah. And that's exactly why I think sitting down with a financial planner is crucial to understanding what are the short-term goals, what are the long-term goals, and with this pile of money, this bucket of money that we have, how can we divvy it up to make sure all of the goals are accomplished in a manner that feels comfortable?
I think another thing with that, and this is something that really shifts in retirement, is when you think about your 401k, it's kind of locked up.
Yes.
If you're 35 or 40 years old, you go, okay, I might have $250,000, but it's really hard to get access to that quarter.
Yeah.
Now maybe you could take a loan, but then you go, wait a minute, I still have to pay that back. It's not like I can just pull this money out.
Yeah.
But when you're stepping into retirement, there's an enhanced liquidity that comes into play where you have access to those funds in a different way. So you don't necessarily have to pull it out and put it in a savings account.
No.
To still have access to it.
Correct.
Should something come up.
Correct. Yeah. Once you reach 59 and a half, you have access to that IRA money. You got to pay tax, but there's no more of that 10% penalty.
Yeah.
But it really depends on kind of what your goals are. I would tell everybody, the money you have saved up was saved there for a reason. Don't pull it out to pay off and get short-term wins. We're looking at long-term goal.
Or split it up into multiple tax years so you're paying a lower tax.
Exactly.
Right?
Yeah.
So if you could say we can pay 12% or we can pay 22%, which would you rather?
Rather pay 12.
So sometimes it's better off to split it into 2 or 3 tax years to keep it in that lower tax bracket.
Yep, absolutely.
If you have clients that are coming in and they don't have any kind of a plan, but they know kind of what they want to do long term, they kind of have that sense of things. Walk me through what a first meeting with you really looks like. If you're sitting down and saying, okay, maybe I've got a pile of statements and I've got questions. I'm going to sit down and talk to Kyle.
Yeah.
What are you going to ask me? What are we going to talk about?
The first thing is kind of getting to know you, understanding a little bit more about what's important personally, professionally, if there's any charitable wishes. But the first question I'm really going to ask is, how can we help? How can we help you? You've done the hard part, which is saving. Now it's time for the kind of the distribution, sending this money out and using it to live on. But how can we help as your advisor and as your planner to make sure that your goals and your wishes are accomplished?
And I think that's really key because at the end of the day, I would argue, and you're welcome to agree or disagree, you don't need someone to explain to you what's on a statement.
No.
Right? So you can read a statement. Yeah. Honestly, I would say you probably can tell someone else what they have better than they can. You know? So because I know there's been times where you've gone, do you know you're paying this much in fees? And they go, I didn't know I was paying
exactly.
And you go, it's right here and here's how it works. Let me show you how to read your statement.
Yeah.
But what you can't get from a statement is, how do you accumulate this money? Why did you save this money? What do you want this money to do? Ultimately, what do you want your life to look like? And how can this money or how can this account help support that? None of those are questions you can get from a statement. So I feel like when we're sitting in those first appointments with someone, a lot of the questions are really trying to understand, where are you trying to go? What are you trying to accomplish?
Yeah.
What are your goals? And then let's help you, because it's almost like a whiteboard of options.
Yeah, it is.
It's like there's all these options available, but do I want to do a 72T? Well, I almost never recommend that. But in this one case, actually,
it makes sense.
Yeah. And I go, well, I know I said I almost never do that, but in this one situation, it actually does. Or anything else. So I think it's important to start with all options on the table.
All options.
And then winnow it down.
Correct. Yeah. I think I think it's really important to kind of understand what the people that we're sitting across from, what they want to do, what their ultimate goal is. I mean, there's a reason why they saved all that money. They may not be able to voice it indirectly or directly to you, but trying to figure out and pull little pieces will at least help the story unravel.
So let me ask you this. Roth conversions, yes or no?
It depends.
I knew you were going to say that.
Yeah.
Here's what I found with Roth conversions. I found people fall into three main camps. There are those that wish they had done them sooner but hadn't. There are those that don't feel like they can. And then there's those that did large Roth conversions, or maybe they did too large of Roth conversions and they were like, that blew me up from a tax standpoint and I'm never doing it again.
Yeah. Yeah.
What do you feel like are the key things to look at when people are considering Roth conversions?
The key things for me is, again, kind of what are they trying to accomplish? The vast majority of our clients and most everybody in the country here has pre-taxed money.
So this is things like your IRA, your 401k, your SEP, your 403b. This is your work account.
Exactly.
Right?
Yeah, this is your work. This is your 401k. This is your money that's gone in there, never been taxed. It's grown. It's never been taxed. And when it's time to start pulling it out, it's all going to be taxed at your income level.
And you're saying most everyone has that.
Most everyone.
Even if you put everything in post-tax, the match is still pre-tax. There's still a certain bucket of money that's likely to be pre-tax money.
Yep. And so it just depends on kind of what the client's goals are and what the prospective client's goals are. Is it that they want to make sure they pass money on to their kids in the most tax efficient way and they're okay paying the tax bill up front? Roth conversions are a great tool for that.
Right.
Is it they have substantial assets and they're really going to be living on much lower income, so we can go ahead and increase their income to what they were at while they were working, and keep them at the same tax rate, same tax bracket while they were in retirement as they were working? Absolutely. Let's talk about doing some Roth conversions. But it all depends, because we have a lot to consider about. We still have to talk about Medicare premiums and IRMAA.
I was actually going to bring that up, and I know some folks have done substantial Roth conversions, knowing it's going to push their Medicare premiums up for a short period of time to keep them in a lower tax bracket from a Roth or from an RMD perspective, which then allows them to stay at that lower IRMAA limit long term.
Exactly. Yeah. I have, I'm working with clients that are doing that right now over the next 3 years. They have substantial assets that are pre-tax. We're doing large Roth conversions, even though they're taking RMDs, even though they're paying a higher Medicare premium because of IRMAA. We're going ahead and doing it over the next 3 years because we know that if we can get it now, their IRMAA is much lower and they know they're going to be passing money on to their kids and they want that money to go to them tax-free. Yeah.
So that's where I think, whether you're talking about Roth conversions, whether you're talking about a one-time distribution, whether you're talking about deferred comp, I think that's something that's really key. We've seen this with a couple clients downsizing of firms, and they say, okay, because of your age, you thought you could take that deferred comp as a 5-pay or over a period of years. Nope, you're getting it as a lump sum now. So I think that tax conversation should happen probably prior to you making a decision on what you're doing with work.
100%. Yeah.
If possible.
Yeah. If you had that ability to sit down and say, hey, this is the buyout, this is what it's going to look like. What does it look like from taxes? Well, let's have that conversation. Sometimes you don't get that opportunity. Sometimes it's take it or leave it. And you just kind of have to make a decision and you don't have much time to think about it.
So all of these questions around these strategies start to show up. You know, what do I do with my 401k? What do I do with my pension? How do I pull it? They're offering me a lump sum. What does this look like from a tax perspective? How do I structure my cash flow moving forward? You know, it's like, what do I want to do from an immediate expenses and payoffs versus not? When it all comes together at the end of the day, it feels to me like what you're saying, and I would believe the same when it comes to this, is that financial planning is all about adaptability and focusing in on what you're trying to accomplish.
Yes. It's not one size fits all. It's not going to the store and picking a shoe off the rack and making sure that it fits. It's It's very much 100% customizable and personal to what the situation, what the clients want.
Yeah. So I would say before you make any kind of decisions, talk with a financial advisor. And then even if you have a financial advisor, it never hurts to get a second opinion. I think you can't get a second opinion from the guy that gave you the first opinion. And beyond that, here at Semmax, we're here to help with all stages. So even if you're several years away from this and you may be thinking, well, I've seen other folks in my company getting these buyouts and getting these opportunities, and it's making me think, am I on track? Am I on the right step? I would suggest that you reach out and speak to someone. We're always available, but I appreciate you taking the time to listen to this conversation. I hope you've taken away a few interesting nuggets or some ways to approach not just the numbers, but the philosophy behind the numbers and how to think about this. This is probably more of the start of the conversation than the end.
Yeah.
But Kyle, I appreciate you joining me. And for those of you that have been listening, thank you so much for your time. And we hope you have a wonderful afternoon.
Thanks for joining us for another episode of the Semmax Way. If you're not completely satisfied with your current financial advisor, give us a call for a second opinion. Please note that this podcast is intended for informational and entertainment purposes only. The content shared on the Semmax Way should not be considered as investment advice. It is always recommended consult your licensed investment representative and a competent tax advisor, respectively, for your fiduciary needs and plans. No statement contained in the Semmax Way podcast or made by its producers, sponsors, host Matt Landon, or Semmax Financial Group is a recommendation. Semmax Financial Group and Matt Landon are not responsible or liable for investment value loss of any kind from any action taken based on information discussed in the Semmax Way podcast. Any opinions or viewpoints in this podcast are shared for information and entertainment purposes only and are not financial advice. We do encourage you to conduct further research and seek personalized advice for your specific financial circumstances. Full disclosure available at semmax.com/podcast. Thank you for joining us, and we look forward to having you tune in for future episodes of the Semmax Way.